How are startups valued? Startup valuations aren't actually all that different from valuing regular companies. Projecting the future growth of a company that's been around for 30 years is a lot easier than for a company that's only been around for 1 year. Here are a few common ways to think of valuations for startups. 1. Discounted cash flow. I'm starting with this because it's probably the least likely to apply to any given startup. Once a startup is no longer a startup and tries to go public, Groupon, Facebook, etc., many analysts will try to project cash flows for the next 5 to 10 years, discount the value of that cash back to the present and figure out what the current value of the future earnings should be. The closest you can get to that for most startups is number 1 from Terence Yang's answer. In fact, in many situations, having revenue or, more often, earnings, can actually make your company less valuable because there's no wiggle room for, when you start monetizing your massively growing user base. Hence the reason many companies simply don't try to make money from users, assuming monetizing wouldn't significantly slow down growth. 2. User growth rates. Consistency of growth rates. This is much more common than number 1, but not as big of a contributor as number 3. User growth matters, but how fast that rate is increasing or decreasing matters more in many cases. If your user growth rate is dropping, your company value is probably starting to flatten out. If the rate is increasing, the value of your company is probably increasing, as long as you are either monetizing a reasonable number or can argue that it's not important yet. The reason this is important is because in place of DCF projections, analysts and corp dev professionals use user bases, market penetration to figure out both how valuable the company is today and how valuable it will be in the future. The other thing user growth allows third parties to see is how predictable your business is. If you're growing your business consistently and you continue to increase your growth rate in a predictable manner, then your future projections are more likely. Startups are exceptionally variable in nature and often have wide swings between success and failure. Lowering that variability or the odds that something sudden will happen makes the startup more valuable. 3. Comparable companies. The value of other, similar companies will have a tremendous effect on the value of your company despite nearly any other metrics. Groupon going public and getting killed in the market has had a massive effect on the valuation of Living Social. If you run a social media app company and another one, roughly the same size as yours in users, revenue, etc., then you'll be valued pretty closely. If you're much smaller, you'll be discounted against that valuation. Often the largest valuations or oddest valuations come in situations where there aren't solid comparables, Instagram, or a new type of company is going public that isn't well understood, Groupon. 4. The strategic value of your firm to someone else in the market or the odds you'll go public above $1 billion within a reasonable time period. This is probably the single most important question of how valuable your startup is. No other number matters. It's all about what someone else will pay to buy you or what the public markets will pay when you sell stock. That's it. Much of this valuation has nothing to do with revenue, user growth, or anything else. It has everything to do with perceptions of the market and needs of the acquiring company. Often by creating a situation where multiple companies need your company, you can push up the value of your company quite a bit. Or, when one major company makes an acquisition, suddenly their competitors will decide they can't be left behind and will start bidding up the remaining competitors. Social media companies were acquired this way for a while by major consumer products retailers. Walmart acquired Cosmix, then Amazon acquired Chorus, and Target built a team internally. Often one of the values of a good VC firm, or a well-connected banker, is that they'll know who needs your startup the most and will be able to help you play multiple parties against each other to push up the price of your company in the sale process. If you're thinking about the valuation of your company from the perspective of raising capital rather than selling your company, think about the above 4 points and work backwards. You probably won't have a very good sense for number 4, but you can reasonably think through the first 3 to move towards a viable projection. Just remember that in figuring out your valuation from the perspective of raising capital, you'll want to balance getting a good valuation so you don't get diluted with having a valuation reasonable enough that you don't end up needing to raise a down round. In my experience, the valuation of very early stage startups is actually done in a very counterintuitive way, based on the amount of money they are raising. For example, if a company is raising a $500,000 seed round, the investors in the round are going to want to own 20 to 30% of the company, so the company will probably be valued at between $1 M pre-money. Why does this work? Because metrics like cash flow don't apply to most startups, and since there are a lot of companies raising money, the valuation can be determined by supply and demand of capital. A great entrepreneur with a successful track record can raise money at a higher valuation, while a first-time entrepreneur with little traction will have to lower their valuation to raise money. You might be thinking, wow, I should just raise a ton of money then, because if I raise more money, my startup will be valued higher. That may seem great today, but the next time you go out to raise money, you'll have to convince investors that you're worth even more. If you inflate your valuation in the early stages, you're setting yourself up for failure, so great entrepreneurs will choose reasonable valuations. At startup stage, valuation is the figure that is decided between the investor and the entrepreneur. At the early stage, concept stage, there is no science or formula to arrive at a valuation. Hence, you go by generally accepted benchmarks in your country, and eventually conclude a deal at what the entrepreneur and investor feel is a fair valuation. What valuation investors may offer for the same plan depends on a variety of factors, including the quality and experience of the team, the investor's view of the potential of the concept, the competition, how easy or difficult it is for other competitors to enter the market, is there any IP or competitive advantage which this team has, etc. In all this, the quality of the team is the most important consideration for investments at the concept stage or early stages. The same business plan, with exactly the same details, could get a very different valuation for a team of college students executing it than what an experienced team would get for the same plan.